This video covers the balance sheet. I'm your professor, Dr. Stephen Haggard. The balance sheet is a financial statement that provides us a snapshot of the company's financial situation at a single point in time, usually at the year's end or at the end of a quarter. For publicly traded firms, these reports must be made to the Securities and Exchange Commission, SEC. Private firms can also have balance sheets, but they're not necessarily reported to the SEC or publicly available. The balance sheet is put together through the use of the balance sheet equation. And when we look at the balance sheet in the next slide, we'll see that the assets are on the left-hand side and liabilities and owner's equity are on the right. The balance sheet equation is simply assets equal liabilities plus owner's equity. In theory, owner's equity is what is left if you sold all of the assets and paid off the debts of the firm. I say in theory because the numbers that are reported on the balance sheet are what we refer to as book values. A book value, for instance, for an asset would be the historical cost, in other words, what we paid for the asset at the time, minus any accumulated depreciation. In other words, all the depreciation that's been charged against that asset. Unfortunately, book value and market value are not the same thing. For example, in one of my industrial roles, I had several lathes and mills that I was responsible for. On the balance sheet, these items had been fully depreciated and had no value whatsoever. However, I was using them to produce $12 million worth of product per year. Therefore, we know they had a market value. And so we say, in theory, owner's equity is what's left over if you sold all the assets and paid off the debts. But that owner's equity would not be the same number using book values versus market values. This is a typical balance sheet. On the left-hand side, we have assets, and on the right-hand side, we have liabilities and stockholders' equity. Liabilities, once again, is just basically another way of saying debt. This is money that you owe to someone else. Notice also that this balance sheet has 2 years' worth of data on it. This is fairly typical as well, so you can look at changes, same account from one year to the next. Let's start with the current assets. A current asset is one we expect to turn into cash sometime within the next year. So cash and equivalents are up there because, after all, cash is already cash. Equivalents would be things like 3-month T-bills, things that you could turn into cash so quickly that you might as well consider them to be cash. Then we have accounts receivable. This is where we have extended credit to our customers, usually on a 30, 60, or 90-day basis, in order to entice them to purchase our products. 30, 60 to 90 days is all within 1 year, so we expect to collect all this money within the next year. Now, I want you to notice something. All these things on the asset side are organized in order of decreasing liquidity. Liquidity is the ability to turn something into cash at or near full market value in a short amount of time. So cash is the most liquid thing up here. The second most liquid thing up here is accounts receivable, because we might not get that money for 30, 60, 90 days. Now take a look at inventories. We expect our inventories to sell out, or at least we hope they will sell within the next year. But if I sell a piece of inventory, likely I will receive an accounts receivable instead of cash. And so that is why we see inventory being less liquid than accounts receivable. First, I have to sell the piece of inventory, then I would have to collect the debt. And so inventory is less liquid than accounts receivable, and accounts receivable is less liquid than cash. Moving on down, we see fixed assets. These are things we expect to provide economic benefit to the firm beyond 1 year. And the big one here is property, plant, and equipment. Now, in some cultures, property can be financial assets, but here we're talking about real assets like buildings and land. Plant would be factories or refineries, things like that. And equipment would be machines. Then we see less accumulated depreciation. In accounting, anytime you see the word less, I want you to think minus or subtract. And the accumulated depreciation is simply the depreciation that has been charged against the things found in property, plant, and equipment over their lives. And so all the depreciation that's ever been charged against those things is contained in that second line. And once we have subtracted out that less accumulated depreciation number, then we are left with net property, plant, and equipment. You may also hear this referred to as the book value of the property, plant, and equipment because it subtracts out the depreciation. Next we have intangible assets. Intangible assets are things you can't touch. That's what intangible means. What are some examples of intangible assets? How about copyrights or patents? Certainly those are valuable things, but they're things that you can't touch. I mean, you might be able to touch the paper that is associated with them, but you can't touch the asset itself. Also, if you have purchased another business for more than the sum of the fair market value of its assets, anything over and above the sum of the fair market value of the assets would be called goodwill and would be included in this intangible assets. And so when we do all the math, we have to add that intangible assets back in, we wind up with total fixed assets. And if you want to find the total assets, all you do is add the fixed assets and the current assets. And you can do that for both years shown here, and you will find that you get the numbers down at the bottom. Moving over to the right-hand side, we have at the top current liabilities. These are things that are going to consume cash within the next year. In this case, all current liabilities consists of are accounts payable. And accounts payable, that's money that you owe to a supplier for materials or services they have provided but you have not yet paid for. For every dollar in accounts payable in the universe, there's a dollar in accounts receivable somewhere, because one company's accounts payable is another company's accounts receivable and vice versa. And so totaling this up is quite easy, and we wind up with our total current liabilities. Down below we have long-term liabilities. This is money that we owe more than 1 year into the future. And we have two big things here. First of all, deferred taxes. These are taxes that we owe but have not yet paid. Deferred taxes show up as a result of a peculiarity in the United States tax code and accounting system. You can use straight-line depreciation for purposes of reporting to your shareholders, but for purposes of paying your taxes, you can use the Modified Accelerated Cost Recovery System, or MACRS, from the 1986 tax modification. And so you wind up with one of these things creating a higher tax burden in earlier years than the other. Straight line gives you higher taxes in earlier years of a machine's life. And so you wind up with these deferred taxes, taxes that you say you've paid on your income statement, but you haven't actually paid yet. That's a little confusing, but the general idea is this. Over time, those deferred taxes, you're going to have to pay them. So over a machine's life, in the beginning, the deferred taxes will increase in the beginning of the machine's life, and then will decrease back to zero by the end of the machine's life. The total number of dollars in taxes that you pay will be identical. It's just a matter of when you pay them. So that's why we end up with these deferred taxes on here. And of course, long-term debt's pretty self-explanatory. This would be money that you owe to banks in the long term, or more likely, bonds. Moving on down, we have stockholders' equity. And preferred stock is another kind of stock that we'll talk about later in the semester. Common stock is the residual claimant at the corporation. In other words, they get the leftovers. After everybody else is paid off and satisfied, including preferred stock, then money flows to the common stock. And it's a little confusing the way that we account for common stock because it actually shows up in two accounts. It shows up in the common stock at par account, and it also shows up in the capital surplus account. This is how it works. If I sell a share of stock for more than the par value, then the par value amount goes into the common stock account, and anything over and above the par value goes into the capital surplus account. That's why it's called surplus, because it's the over and above. Now, how do I know how much total I have issued over the firm's life? I simply add together the common stock at par and the capital surplus, and that total tells me how much common stock I've issued over the life of the firm. Below capital surplus, we see accumulated retained earnings. At the firm, whenever we have net income, that net income flows to two places. First, to dividends, if we pay any dividends, which we are not required to, and anything over and above the dividends flows into accumulated retained earnings here on the balance sheet. They'll show up as addition to retained earnings on the income statement. And that accumulated retained earnings on the balance sheet represents all the undistributed profits of the firm over the firm's life. So any money we've made but not paid out as dividends shows up here in accumulated retained earnings, and those belong to the shareholders. How do I know? They're here in the stockholders' equity. Specifically, they belong to the common shareholders. The next line down says less treasury stock. Once again, less means minus in accounting, and so we are going to have to subtract out that less treasury stock to get our total equity. But let's talk about what shows up here. Anytime the firm repurchases its own shares, which is totally legal, it gets put into this less treasury stock account at the amount that was paid to repurchase that stock. Because the money flows out of the corporation, then we know that equity has gone down as a result of that repurchase. And so we have to subtract the addition to treasury stock. Finally, if we add all the current liabilities, long-term liabilities, and total equity together, we get total liabilities and stockholders' equity. And I want you to notice that the numbers at the bottom of these two columns are identical to the bottom of the assets. That is not an accident. This is a balance sheet. It has to balance. Now, how does it balance? It turns out that the common stock is a residual claimant, and so if the assets go up by 10 million and everything else stays the same, then the shareholders' equity will go up by 10 million. It will show up in the accumulated retained earnings, unless it was a matter of issuing new stock to purchase those new assets, in which case it would show up in your common stock or capital surplus accounts. In other words, the stockholders' equity expands and contracts to take account of changes in assets if we are holding liabilities steady. You can think of the balance sheet equation this way. Assets minus liabilities equals owner's equity. What if we sold off all our stuff and then paid off all our debt? The money that is left over is the owner's equity. Let's discuss the difference between book value and market value. Oftentimes students get confused and think that the book value that you see on the balance sheet or on the firm's books is actually what a machine or building or something else is worth. And it's only true on one day of that asset's life. On the very first day, an asset is recorded on the books at historical cost. In other words, what we just paid for it. On that day, book value and market value are identically the same thing. After that, book value is merely historical cost minus accumulated depreciation. So we take that original amount that we paid, and every time we depreciate that thing once per year, we subtract that depreciation, and now the book value goes down. Now, in general, the market value of assets might go down, but will they go down exactly the same amount every year according to the depreciation schedule? Probably not. What is the market value then? The market value is what you would get if you were to sell the asset. And so book value does not usually equal market value. In fact, for an extreme example, I will tell you about my own situation. When I took over my first business to run in 1997, all of my machines were almost as old as I was, so they were depreciated to zero. So my equipment had a book value of zero. Yet somehow I was able to use that equipment to produce $12 million per year of revenue for the company. If machines can produce $12 million in revenue, do you think they truly have a zero value? Absolutely not. I could have sold some of my machines for as much as $300,000, and the least valuable machine in my operation was still worth $50,000, even though the book value of all of those machines was zero.
Finally, I'd like to tell you about net working capital. We define net working capital, also sometimes just referred to as working capital, as current assets minus current liabilities. Remember that current assets are things that are going to produce cash within the year, and current liabilities as things that are going to consume cash within a year. Therefore, net working capital is a measure of the firm's ability to meet its obligations over the next year. If net working capital is less than zero, then current assets must be less than current liabilities, and the firm will be unable to meet its obligations over the next year unless it takes some action. What kind of action could a firm take to boost its net working capital in such a situation? Well, they could issue long-term debt or perhaps sell stock, neither of which are a current liability, and they could put the proceeds into cash or inventory, both of which are current assets. These maneuvers would increase current assets while not changing current liabilities. Therefore, they would increase net working capital.